two markets are telling opposite stories about the same economy. Energy is dropping as if demand is disappearing. The Nasdaq is rising as if growth has never looked better. One of those readings may be too simple.
Lower energy costs can help technology margins. If power, transport, and input costs ease, growth companies get relief without needing demand to collapse.
Unless energy is falling because demand is already weakening. Then the apparent gift to margins is actually a warning from the real economy.
That is today's contradiction. Is cheaper energy a tailwind for tech, or is tech ignoring a message that commodities saw first? We can test both stories without predicting which market moves next. First, the observed split. Across the latest three-session window, natural gas fell by roughly 10% and settled near $2.90. Over a similar window, the Nasdaq 100 gained a little more than 2% and remained above its Ichimoku cloud.
That is a clean momentum divergence. Capital is rewarding the growth index while leaving a major energy contract under pressure.
And it is large enough that calling it random noise avoids the real question. Why did cheaper energy fail to produce a broad, obvious risk-on move across the rest of the tape?
To answer that, we need two competing mechanism chains. The first chain is the relief story. Energy prices fall. Operating and transport costs ease. Inflation pressure can cool. Long-term rates may face less upward pressure. High-duration technology valuations receive room to breathe.
In that version, the Nasdaq is not ignoring energy weakness. It is correctly translating lower costs into stronger expected margins and a friendlier discount rate environment.
But every arrow in that chain is conditional. A lower commodity price does not guarantee lower inflation, lower yields, or stronger profits. Natural gas can fall for reasons that have little to do with the cost structure of the largest technology companies.
The relief story becomes stronger only if falling energy is joined by cooling yields, stable earnings expectations, and broader participation in equities. The second chain is the warning story. Energy prices fall because expected demand weakens. Industrial activity softens. Revenue expectations eventually come under pressure. The Nasdaq remains elevated because capital is concentrated in a narrow group of growth names.
In that version, lower energy is not a gift. It is an early symptom. The index can look healthy while the economic foundation beneath it becomes less supportive.
But a commodity decline alone cannot prove a growth slowdown. Supply, weather, storage, positioning, and contract-specific flows can overwhelm the macro signal.
Exactly. Natural gas is evidence of tension, not a complete diagnosis. The bond market helps separate the two stories. The U.S. 10-year yield has remained around the mid-4% area rather than collapsing alongside energy.
That is the awkward part. If natural gas were falling because growth expectations had clearly broken, investors might also demand less compensation on long-term government debt. Instead, the long yield remains restrictive for expensive growth stocks.
Yet the Nasdaq is still holding above its cloud. Price is saying that, so far, earnings optimism and momentum are absorbing the pressure from rates.
That gives us a second contradiction inside the first one. Energy is signaling weakness, yields are not delivering much relief, and tech is still rising.
The momentum explanation is concentration. Investors do not need to believe the whole economy is accelerating. They only need to believe that a small group of large technology companies can keep converting spending into earnings.
Concentration can support an index and conceal weak breadth at the same time. If leadership narrows further, the headline index becomes a less complete description of risk appetite.
So the Nasdaq chart must be read as evidence of current leadership, not proof that the commodity warning is false. Here is the validation map. For the relief story, watch whether the Nasdaq stays above its cloud while long yields cool and more equity sectors participate.
If those conditions appear together, lower energy is behaving more like a cost tailwind than a demand alarm.
For the warning story, watch whether natural gas loses its cloud floor, cyclical assets remain weak, and the Nasdaq falls back into its cloud while yields stay high. That combination would show that narrow leadership can no longer hide the tension.
Neither single price level settles the argument. Confirmation requires several markets to tell a consistent story. There is also a timing problem. Commodity markets can react to supply and demand expectations before corporate results show the effect. Equity indices can remain strong while investors wait for evidence in revenue and margins.
That delay is why divergence can persist. A contradiction is not a countdown clock.
And persistence does not make the risk disappear. It makes the confirmation conditions more important, because the eventual resolution can come through energy recovering, tech weakening, or both moving toward a new balance.
So what is the market saying? Not one thing. Natural gas says the energy demand balance has weakened sharply. The Nasdaq says technology leadership remains intact. The 10-year yield says financial conditions are not offering an easy explanation for either move.
The momentum belongs to tech until its structure loses confirmation.
The warning remains active until energy and broader cyclical markets show that the decline was isolated rather than systemic.
The useful question is not which market is lying. Ask what mechanism would allow both moves to be true, and what cross-asset evidence would prove that mechanism wrong. That is the experiment. Subscribe for the next Weekend Lab, and follow the Daily Market Notes at Market Validation Lab on X.